Good afternoon, ladies and gentlemen. Welcome back to this weekly market review. We have the F1 just over the weekend and Ferrari won. I think Gerald is definitely at the front line seat looking at the Ferrari sports car go past the final line and win the trophy. So how was the weekend, Gerald?
Unfortunately, I wasn't at the F1. I was watching it from home and actually looking at how the F1 will potentially affect the Singapore REIT market. So that is something that we will share with the participants of the weekly market review today in terms of how an event like this can actually affect Singapore listed stocks and REITs.
I see. So I think without much further ado, we will pass over the time to you to start the presentation because I think our viewers are all very excited to hear about that.
Okay, thanks so much, Sunny. So to start off, as usual, we'll have a bit of a disclaimer. Today's session is for education and information purposes only. While we are going to be talking about specific stocks and sectors, it should not be taken to be financial advice. If you find today's session helpful, do leave a review for us on Google using the link that is provided. Next, do consider joining SIAS as a member for only $1 per month. With that, you get access to various programs, including the monthly Ask SIAS, where you can ask both Sunny and us further questions about the Singapore market or investing in general. Okay, so without further ado, I will start with a quick recap around what happened in the past week. Overall, we saw mixed performance in the US. The S&P 500 was down by about 0.2%. This was led by losses in the tech stocks. As we can see, the Nasdaq was down by 0.4%. But on the other hand, we saw that some of the industrial stocks actually did better, which is why the Dow Jones managed to see a bit of gains. But what really stood out for us in the past week was that the Singapore market, as represented by the STI, actually outperformed. And this is something that we will discuss in more detail later during this webinar. Okay, so what actually moved the market last week? We had the US Consumer Price Index data. This is something, if you joined our webinar last week, you will have heard that it is something we are looking out very closely for to get an indication around inflation in the US and what this means for the US Federal Reserve's interest rate policy. So the number that came out is that the core consumer price index actually rose by 0.3% in August compared to July. And this was broadly in line with estimates. So no big surprises here. We see that the month-on-month increase in the core consumer price index has been pretty much in this range of 0.2 to 0.4% over the past few months. So that would probably not cause the Fed to be changing its interest rate direction in a very significant way. So what else can we actually see from this CPI data? I think if you look at the headline reported numbers, those are effectively still at fairly elevated levels. And that is because of the impact coming through from energy prices. But one of the key reasons why we look at core CPI is because of the fact that that would strip out energy and food prices. And that is a measure that the Fed would effectively use to determine whether it needs to raise interest rates further. So with this data that's come out, how will the Fed potentially react? A few weeks ago, we talked about the Fed Watch tool. So we will go back and look at what the latest Fed Watch tool is actually telling us. Okay, we have the FOMC meeting that is coming out this week on the 20th of September. And what we see here is that almost 98% chance that the Fed will keep interest rates unchanged. Okay, so it seems something that is broadly expected, given that the inflation numbers continue to be in line with expectations. Okay, and what we also see from this chart is that there seems to be no further rate hike over the next 6 months. And what investors are looking out for next is whether we might start to see a rate cut sometime in 2024. So at this point in time, if you look at what this chart is showing us, by June 2024, there is a greater chance that we'll see a rate cut compared to interest rates being kept at current levels. So that is something that investors are next looking out for if the Fed is now starting to pause on its interest rates hike. Okay, so that is the good news. No further rate hike expected in the upcoming FOMC meeting. But then next, I will share what the bad news actually is, which is that the expectation around when the rate cut will come through is getting pushed back for a later date. So this is what a lot of investors mean by interest rates remaining higher for longer. So staying at this elevated level of 5.25 to 5.5% for a longer period of time before we start to see rate cuts coming through. And this is what we see in this chart. If you look at what the expectation is for May 2024, 1 month ago, actually, the expectation is that there could be rate cut by May 2024, and that will bring the interest rate down to 5 to 5.25% from the current level of 5.25 to 5.5%. But if you look at what the latest numbers are showing us, effectively, there's now a higher probability that it will be kept at this level in May next year versus being lowered. Okay, so the very strong US economic data has actually led investors to believe that the interest rates will stay higher for longer. Okay, so if you look at what this actually means for the Singapore market, we'll look at what are some of the top gainers and losers over the past week. If you look at the top gainers, we see Wilmar up 4.1%, OCBC up 3.8%, UOL 3.6%, Mapletree Pan Asia Commercial Trust 3.4%, and last but not least, Singtel also 3.4%. First and foremost, we see that the banks have actually been very resilient. We see here OCBC is actually up 3.8% in the past week. So this is once again an extension of the interest rate expectations, because if interest rates were to be elevated, then the expectation is that the Singapore banks can potentially benefit from having a higher net interest margin. The other commonality that we see amongst these names is that quite a number of them have got China exposure. So if you look at Wilmar as an example, it is one of the largest commodity processing companies in China. And with the rebound that we see in the Chinese market, as well as improved sentiment given the stronger than expected economic data, names that are exposed to China has started to see a bit of recovery. Next, we look at the top losers. Last week, we saw Yangtze Shipbuilding down 2.9%. The Jardine names, including Jardine Matheson, down 2.6%. Hong Kong Land down 2.5%. Within the REITs, we have Fraser's Logistics and Commercial Trust down 2.5%. And last but not least, oil and gas company Seatrium down 1.4%, despite the strong oil prices that we have seen. So once again, is there any similarity amongst these names? I think if I look at, say, the Jardine names as an example, Yangtze Shipbuilding, they are typically seen as names that benefit from a strong US dollar. And say Yangtze Shipbuilding as an example, its contracts are in US dollar, but its cost is in Chinese yuan. So it benefits from a strong US dollar. But in the past week, we see that the US dollar has weakened slightly from its recent highs. So that might have actually led to some profit taking in this US dollar exposed names. Okay, so in terms of the key news for the past week, we see Fraser's Hospitality Trust, the share price actually gaining at the back of increased optimism about Singapore's tourism sector ahead of the F1 race. Within the REITs, very divergent performance because we see Keppel Pacific Oak US REIT share price hitting an all-time low due to concerns about the US office market. Last but not least, we also saw Olam share price hitting a 52-week low, and that is something that we'll talk a bit more of later. Okay, so we're talking about the F1 to start with. So we'll look at Fraser's Hospitality Trust. So this is a hospitality REIT with hotel assets in the Singapore market. And if you look at the portfolio, about 42% of its entire property portfolio will come through from this Singapore property assets. Okay, so this actually is the largest part of its portfolio, but it also has got assets in other parts of the world, such as Australia, UK, Japan, Malaysia, as well as Germany. Okay, so if you look at how the REIT operational performance has been, we saw very strong recovery in the RevPAR, or the revenue per available room, over the past year. Okay, so for the 9 months ending June 2023, that actually grew by 77% compared to the previous year. And if you were to look at what this RevPAR is compared to the pre-COVID levels, effectively it has already exceeded where it was prior to COVID. So even before the recent F1 race, we already see that we are having a recovery in the tourist arrivals into Singapore. That is actually leading to a higher revenue it is able to earn for every room that is operating in Singapore, and helping to boost sentiment towards the stock. Okay, so if I were to compare Fraser's Hospitality Trust with some of the other hospitality REITs, I think some of the other names that investors commonly look at would be, say, Far East Hospitality Trust, as well as CapitaLand Escort Trust. If you look at the Singapore as a percentage of the portfolio, I mentioned earlier that Fraser's Hospitality Trust would have about 42% of its assets in Singapore. Far East Hospitality Trust is a pure Singapore exposed hospitality REIT. And lastly, for CapitaLand Escort Trust, it is at about 18%. If I were to look at the RevPAR growth, we see that Far East Hospitality Trust is the one that saw the most increase in its RevPAR growth over the most recent period. That is followed by Fraser's Hospitality Trust. And last but not least, for the gearing levels, all of them have got gearing levels that are below 40%. Fraser's Hospitality Trust at 35%, and Far East Hospitality Trust even lower at 32%. If I were to look at the dividend that they paid out in the first half of the year and actually annualize that, then the dividend yield that they actually offer investors will be in the range of 5% to 6%. Okay, so this is the share price of Fraser's Hospitality Trust. I think a lot of investors have been concerned about the performance of the REITs year to date, with the continuous rate hikes, as well as expectations that interest rates will stay higher for longer. But if we were to look at this chart, Fraser's Hospitality Trust is actually one of the REITs that still managed to be fairly resilient. What we see is that the share price actually picked up over the past 1 or 2 weeks, given the expectations that we might see a bit of a recovery in the Singapore tourist arrivals, especially with the boost coming through from the F1 race. So that is Fraser's Hospitality Trust with the stock code ACV. Next, we also get a lot of questions about Keppel Pacific Oak US REIT. In the past week, the share price actually came down to an all-time low. And that is really driven by concerns around the exposure towards the US office sector. You may not feel it if you're actually going around Singapore Central Business District today, because it is still very lively. A lot of people are actually going back into the offices to work. But if I were to look at the US office sector, it is a completely different picture. If we were to look at the availability rate of the office assets, the US national average is at about 24%. Okay, and if you look at selected cities such as San Francisco, it can actually go up to as high as 35%. So a lot of empty office buildings around, and that is actually driving concerns around the leasing activity in the US office market. Okay, so what a lot of investors would do is to compare the different office REITs with exposure to the US office market. Here, what we see is a comparison between Manulife US REIT as well as Keppel Pacific Oak US REIT. First and foremost, they would have different sponsors. We also see that the committed occupancy is different. Keppel Pacific Oak US REIT will have a slightly higher occupancy compared to Manulife US REIT. And if I were to compare the gearing levels, Keppel Pacific Oak US REIT will have a more comfortable gearing level of 38.4%. And that would allow it to have more leeway, even if it faces the risk of a devaluation of its US office assets. Okay, so this is the share price of Keppel Pacific Oak US REIT. We have seen that this year it has really been quite challenging because of all the concerns around the US office exposure. So in terms of what we are looking out for next, would be the valuation of the properties that it has in the US, because that will effectively determine what its gearing level is going to be. Okay, last but not least, Olam, where we saw very big movements in its share price over the past week. First and foremost, we saw that in the Nigerian media, there were various reports about fraud allegations, but the company has actually come out to actually deny these allegations. But the share price still continued to come down after the company confirmed a media report that the Nigerian unit has actually posted a bond for its director to secure his continued cooperation with any legitimate requests from the Nigerian authorities for information or assistance. So the challenges that it is facing there is definitely leading to investor concerns, and as a result, we have seen the sell-off in the share price in the past week. If you were to put this aside and look at the operational performance, Olam in the first half of this year also saw a lower profit, and that is driven by the fact that it has higher finance costs in the first half of this year versus the first half of last year, because of the relatively high net gearing that the company has. Okay, so the chart on the right in this presentation will show you the gearing levels that it has. And with the fairly elevated gearing levels, that has actually led to higher finance costs, and as a result, lower profit in the first half of this year. Okay, so this is Olam's share price effectively coming off over the course of this year, driven by a number of factors. I mentioned the lower profit reported earlier as one of the drivers. And then more recently in the past week, because of the issues faced in Nigeria, also facing a more significant sell-off. Okay, so what are we looking out for this week? One of the key events is definitely the Fed meeting that is happening on 20th of September, and investors will be looking out for what the interest rate direction is. I shared earlier that investors are not expecting any further rate hikes, but even then, what investors are looking out very closely for is what its language is, as to whether there could be more interest rate hikes going forward. We also see a number of interest rate decisions by central banks globally. So apart from the US Federal Reserve, the Bank of England will also make an interest rate decision this week. So with that, I'll pass over to Sunny, who will share what this means in terms of the technicals of the key indices.
Okay, thanks, Gerald, for the insightful sharing. I think that sort of gives us a bit of insights into what the F1 can do for the REIT markets as well. And of course, the ending point there, the central banks meetings, is, I believe, what will be driving the markets in the next 1 or 2 weeks, especially on the global markets like the major ones in US. So I'll start with the Singapore side first. So this is the STI index chart. As you can see over here, we have been talking for a few weeks, at least 1 or 2 weeks for now, that we are seeing a head and shoulder formation that's forming on the charts right now on the STI daily chart. And we have that right shoulder more or less coming in on last Friday, as you can see over here. And today we see a red candle. So a head and shoulder pattern, if you go to Investopedia to study up what does the head and shoulder means, if it's a bearish chart pattern, and if the price is unable to close above the neckline, then likely we will see a pullback, a very steep pullback towards where the next stronger support will be. So the right shoulder, I would say that now has already been confirmed based on last Friday high. As you can see, last Thursday and Friday, most of the STI gain above 2% came in on Thursday and Friday on top of the CPI and the PPI data from US. So we saw a 0.96% jump on last Friday and a similar one on 0.95% on Thursday. So this is what sums up the STI index last week. So now we see a red candle because I think if there are traders around studying the technical analysis, this is a bearish signal to us. At least this is what the chart pattern says. So where will be the next support level for the STI index, you may be asking. So the next support, I believe, would be this level over here, which is the 3150 or 3155 level. Because at this point of time, we see that there is more or less a three support points that says that we will see a bounce over here since the end of May, and then we have early part of July, and also recently in the middle of August, we see that the STI jump around this area of the price, around the 3155 or even the 3100 level, which is a year-to-date low in the March period. So connecting the low of the March as well as the recent low that we see in July and August, we have a firmer or stronger uptrend support line amid a gentler slope. So that means that this, if there's pullback going to happen, we are definitely looking at the 3150, which is also the lower bound of the Bollinger Band as the first support level for STI, which I will not be surprised if we see a very steep pullback towards the 3150 level due to this very prominent head and shoulder pattern. The MACD is still showing a positive sign because you can see that the last 3 or 4, maybe even 5 trading sessions, the momentum is still accelerating. But after we get an update from the today's candle or today's trading, we may see that the MACD histogram starts to subside a little bit, which means that the uptrend momentum might be subsiding. So I'm just reading a little bit forward, but do look out for that confirmation from the MACD indicator. The RSI reading is now at 59. The previous time on Friday, we saw it at 63. So around this 60-point region is still telling us that there's a strong and healthy momentum that is inside the STI index right now. We have not reached the 70-point mark, which is the overbought signal. So once it triggers that, we may see a steep pullback. So even though we say that we have a head and shoulder pattern, the technical indicators are still on the positive side and still showing strength. So I believe this head and shoulder, it might take the indicators a little while to reflect the momentum change, and then after a pullback may happen. So this is a sign that I think investors or traders should take note of, and if they have any exposed position in the STI, they might want to consider taking some profit off the table if the indicator starts to confirm a change in direction on the STI index. Okay, next I'll move to Asia, which is the Hang Seng Index. So last week there is a few data coming out from the Chinese side. So basically the industrial data and the retail sales data came out better than analyst expectation. So we are seeing that the economic situation in China is starting to get a little bit better, at least based on the data that's coming out. So the worst might be over, but of course there might still be some volatility going forward. But today we see the Hang Seng Index down close to another 1% already. So we are still seeing a lot of concerns on the Chinese property markets. So this is the biggest concerns that I think the Hang Seng Index have for now, because there's also a significant part of it exposed to the property developers. So that is the concern that we have now on the Hang Seng market, although the economic data from China is improving. So on the technical perspective, earlier we said that the low is around this double bottom over here, which is around the 18,200 points level. We have seen that being breached somewhere in the late part of August, and then we see a rebound back up to this level, which gives us the confidence again. However, today, the index starts to pull back a little bit. So this is more or less a reflection of what I said earlier. The worst might be over, the bottom might be in, but then there's still some volatility ahead, which means that we will not be able to see a direct rebound upwards based on the Chinese data that we are experiencing. So the candlestick now is still below the 20-day moving average, which is the black color line that you see here. That is the Bollinger Band basis as well as the 20 days moving average. If you look at the MACD indicator, it is not showing you any clear signs. It is, I would say, slightly negative. Although you have a positive, slightly positive MACD reading, but both the MACD line and the signal line, the trajectory looks to be going sideways, and they are still below the zero baseline. So I think momentum at this moment is still weak, and we are still waiting for a trigger or a catalyst to bring it back up to see signs of a divergence of the MACD line against the signal line towards up above the zero baseline. RSI more or less also confirm what the MACD is saying. You can see that the reading now is about 42. The 14 days RSI moving average is 44. So for the past 14 weeks, we are seeing the RSI hovering around the 40 points level, which is about 10 points below the 50-point neutral mark and about 10 points away from the 30-point oversold signal. So as of now, I think Hang Seng, according to both indicators, are in a consolidation mode, and until we come to a point in time where we have a catalyst, then we will have a clearer direction of where Hang Seng Index is heading. But for now, based on the improving economic data coming out from China, I think this might be a bottom and a consolidation is happening right now. Okay, so we talk about the central bank decisions that are coming in. So a lot of market movement, especially on the US and the European side, will be dependent on how this announcement will be. So you can see that we see a pretty much Dow Jones ending the week slightly positive 0.1 above, just a notch above the neutral mark. But then you can see that on Friday itself, there's a big red candle. I think what that signals to me is a lot of investors going into the FOMC meeting today, or the central bank meeting this week, right? They are taking a risk-off kind of sentiment because there's a lot of uncertainty. Although we see that there's a 98%, and the latest one that I checked on the CME Fed Watch 2, we are seeing a 99% chance that Fed will pause the interest rate over here. But the recent data that I read into the energy prices, we can see that oil price is coming up very strongly and persistently staying above the $90 a barrel kind of a pricing, with the US replenishing their reserve oils, and of course the cut in the OPEC output. I think that the inflation pressure might continue to increase going towards the end of the year, and then hence the probability, although we have a 99% chance now that there will not be any rate hike, but if let's say inflation were to get worse because of energy prices, the situation might change based on the probability of going into forward next few months. And of course, I think this week meeting, we are seeing a projection of what the Feds will be saying going forward into the next quarter. So I think that is something also on top of the language that we are looking out for. We are looking out for the projection of the Fed official as well. Okay, so Dow Jones Index, I would say on Friday it's a risk-off kind of thing, but then we managed to close above the 20-day moving average. So that is a slightly positive sign that maybe the uptrend is still intact, but the market is undecided right now. The MACD is now looking pretty neutral as well. You can see close to what the Hang Seng Index is also saying right now. So the MACD is like neither here nor there. We are just trending sideways, waiting for some kind of direction to show us whether we can carry on the push that we see since the beginning of the year, or whether this is a turn and the Fed interest rate might already be too high. Okay, so the RSI is also close to the 50-point neutral mark, now reading at 48, so just 2 points below 50, so not telling you anything whether there's strong or weak momentum. It's just neutral at the moment. So I would say that the Dow Jones Index is just waiting for what the Fed is going to say this week, and then from there, investors will take a direction or take a stand, and then we will have the greater clarity from there towards the end of the week. So S&P 500, you can see last Friday dropped by 1.22%. Actually, on Thursday itself, or even 1 or 2 days before Friday, you can see that after the CPI data was announced, after the PPI data was announced, market was actually very positive towards those data that was coming out. Although, in my opinion, the CPI data was a little bit warm. Some of the analysts are saying that the CPI data was actually a bit hot. So I think, but market take it that even though it is a bit warm, it's not too far away from the consensus. So they are still positive and then buy it up. And then we can see that's why on Wednesday, Thursday, market start to went up. But Friday, it comes down with the realization that, hey, next week, it's not that certain yet, although the CME Fed Watch Tool say that there's a 99% probability. So we are holding on to the 20 days moving average as well as a mini double top here, which have a change in polarity to provide a little bit of support on last Friday closing price of the S&P 500. If you were to drop further, definitely the amber line will come in. The amber line, which is the 100 days moving average, which coincides now with the lower bound of the Bollinger Band at 4,360 points. So that will provide the next support level for S&P 500. And that would also coincide with the low that you see on 18th of August. So this might become a double support. And then if this is going to happen, it may have negated the uptrend line that you see over here, this green line connecting the low of March as well as May. And S&P 500 may go into a range bound kind of a trading pattern in the next few months if that happens. Okay. MACD indicator not saying anything. RSI also grey neutral, also not saying anything. So we are a bit of the directionless right now and looking for the next catalyst to give us some kind of signal. On the Nasdaq Composite Index, which is not as positive as what the Dow and the S&P 500 is showing, we close below the 20 days moving average. That means that on the short term, it is slightly bearish. So we expect the Nasdaq Composite Index likely to have a bit more of a pullback towards the amber line, which is the 100 days moving average, now around the 13,350 points. And this is also around the support level that we see somewhere on the 17th of August, 13,180 points. This is where we see buyers start to come back in again. So this is the latest signal that we see where the buyer is right now on the Nasdaq Composite Index. On the MACD indicator, MACD is slightly negative. We see that it is poking a little bit down below the zero baseline. The MACD histogram has already gone negative. So this is the first sign of another negative signal that we see on the technical analysis of the Nasdaq Composite Index. The RSI is reading at 46, so it has reached below the 14 days moving average of the RSI at 53. So now it's also negative. And looking at the trajectory, it looks like there is a slightly heavier kind of a negative momentum inside the Nasdaq Composite Index right now. So as we know, among all the three indices, Nasdaq is the most volatile one. So I would not be surprised even if the price pull back to the 100 days moving average around the 13,350 points level. And then after that, it can have a bounce back up depending on what the data is. So the volatility of Nasdaq Composite Index can be quite volatile. And if you want to get a firmer footing to join back into the tech race that we have been observing the past few years, then you definitely want to look out for the 200 days moving average, which is around the 12,800 points level, or even the firmer uptrend line that you see here connecting the low of December as well as the low in March. That will be around the 13,000 handle to look out for to get a firmer footing into the Nasdaq Composite Index. So that is the update I have for this week, weekly market review. Any more comments to add, Gerald?
Hi, Sunny. Thanks so much for the update. I think basically we are just awaiting the latest FOMC meeting, and the market has been quite directionless while we are awaiting where the Fed interest rate hike direction might be. So we'll continue to keep a lookout for that. And for investors who continue to tune into our weekly market review, I guess that's something that we can have a further discussion on at next week's weekly market review.
Yes. So I think that's all we have for this week. Time is running out. So if you think that the content that is curated by Gerald is useful, do give us a like and share, and do consider hitting that subscribe button on our YouTube channel. And we'll see you again next week in the next weekly market review.
Thank you.